Hello, everyone. Welcome back to another episode of Spark Your Fire. It's our Friday wrap segment again. As always, the Friday feeling, you can't beat that. Look at how happy John is today with me. How are you, John?
I'm well, David. How are you doing?
I'm very good, very good. Thank you. I think, we are seeing, I don't know, I don't even know how to describe this now in terms of the big property market that we're seeing. Obviously, there's little markets and very specific around, but yeah, it's just I have to say it's just a fascinating time to be alive, to be able to see all these different things that's happening, whether that's RBA looking at restructuring and changing, which I know they're following the central banks around rest of the world and US, that's for sure. To days on market reducing, to our actual observations on the ground, and from the inquiries that we're getting from our businesses. So there's just so many things to cover. And I thought, I think we'll keep today's our chat a bit conversational in terms of what we're seeing at the moment on the general property market. In that sense, we focus on different areas ourselves. But yeah, look, I think to kick it off, we've been chatting offline that our businesses actually we've been seeing inquiries coming through. I've had a pretty strong March and April at the moment. I'm a very small business, of course, so it can't represent everyone. But in terms of what I'm seeing, the inquiry levels definitely have picked up. People are looking to refinance. People are still looking to be able to release equity. People are still looking to buy, upgrade, and a lot more people looking at getting back into purchasing another investment property again. Okay, so so it's actually quite a mix. Whereas I would say 3-4 months ago, investor market is pretty dead. Like literally no one is thinking and considering, like even if they can, they're like, oh, we want to be conservative because we don't know when the market is potentially going to turn and uptick again, right? But I don't know, how are you seeing at the moment, John? You being as a buyer's agent, I guess your inquiry levels must be starting to see over the roof now.
Yeah, my inquiry levels really started popping in February. Second half of last year was much quieter, so it's been a bit explosive actually so far this year, which has been great.
Yep.
Interestingly, my buyers are largely owner occupiers.
Okay.
Yeah, some first home buyers in there. Interestingly, not investors, or there's always sort of the investor owner occupier hybrid, but yes, so they're owner occupiers. And what I'm seeing, so I'm definitely seeing it come back. I'm just seeing more people at inspections. I'm in lines and I'm taking my shoes off on the Saturday inspections and those sorts of things, which I don't particularly like. But so there's sort of broadly, there's broadly sort of, I'm seeing houses really hard to buy at the moment. I'm seeing the good stuff is very scarce. I suppose sellers are holding on to their better properties and selling the properties that they don't like, perhaps. But what I'm also hearing is the agents saying, look, now that there's the kind of the proof is in that the real estate market's coming back, the sellers are absolutely committed to holding off on selling until the end of the year when they know they can get, let's say, 5, 6, 7% more. So definitely, like the market coming back, particularly because we're in the early stages of a market recovery. I think the market bottomed, let's say, in November last year, and here we are a couple of percent up. Because there's confirmation that the market's coming back, it's almost entrenching that supply problem. So, but broadly speaking, what I'm hearing is, and what I'm seeing is, units, townhouses, less so townhouses, but units are harder to sell, easier to buy. Houses are, what's the opposite of that?
Harder to buy.
Harder to buy, easier to sell. They're selling houses within a week. I'm seeing them pop off, and I'm trying to obviously get in earlier. But houses are tough to buy, and units are easy to buy. That's certainly what I'm seeing. Now that'll change, and an optimism in the market broadly will drift into units as well. But I bought a unit. I bought a townhouse this week. I'm still looking for some houses, and my lead time on houses is much longer than my lead time on units, which can be just a couple of days.
Mm-hmm. And I think, and you're talking in general, this is specifically for Sydney markets because I know, predominantly you operate in Sydney. And I guess, a lot of investors were looking at units in Sydney market because they were much higher gross rental yield as they hold. And as you can imagine, when the rate gets too high and it's tough to hold, as you said, they probably try to get rid of the investment properties first and maybe the not so good ones, within their opinion, at the moment. So maybe that's one of the reasons contributing to why there's a lot more units available at the moment for buyers to choose from, whereas houses, not as much.
Yeah, it's easier to get. It's funny because it's easier to get it wrong when buying a unit. Like there's a lot more variability in terms of units, whereas buying a house, if you've got a reasonably symmetrical block, it's level. It's hard to get that wrong. I mean, even if you'll have, everyone has problems. You'll have problems. There might be a leaky roof, but there's so much value in a house that you can't go too far wrong over long periods of time. In units, you can really screw that decision up. You can buy, something with the wrong aspect or the wrong layout or whatever it is. So there's a lot more tripwires when it comes to buying a unit, in my opinion. Believe it or not, even though it's only small. And so I think that, again, good units are selling quickly, bad units are not selling. And that's the dance of real estate. I mean, the thing that makes real estate exciting is that it's non-fungible. It's no two properties are the same. So
that's very true.
You've got to use a lot of judgment. It's very hard to automate real estate as well, just because of that.
No, you're absolutely spot on. And from what I'm hearing as well, the auction clearance markets at the moment for Sydney has also started. The trend is back on. I think was it 77 preliminary clearance last Saturday? Yeah. The numbers weren't. The number of properties sold though wasn't high, or registered for auction wasn't high though, from memory.
It's creeping up. It was obviously it was lower than the previous year, higher than the previous week. This weekend and the previous year was Easter. So I think that it's hard to compare, but the clearance rates are creeping up. Anything over 70% usually means prices are rising, and generally speaking, they've been over 70% every week this year, except for I think one weekend. So we're definitely in a recovery mode. 78%, which is where we are, is starting to get hot, and all the real estate agents I'm speaking to are saying the market's crazy, the market's hot. It'll probably level out and settle down, but I think there's a real sense of FOMO right now that, oh, damn it, I've missed the bottom. No one should think like this, because bottoms take months, right? And you'll never get the bottom, so don't worry about the bottom. Just buy good property, right? But it is busy out there. It is busy out there.
Yeah, that's what I'm hearing as well. And looking at some of the results, for houses auctions, it's very easy for the final outcome to be, I don't know, 200, 300K above the actual price guide, right? And like in that instance, it just shows the amount of competition that's out there at the moment. And I think the main contribution is still the lack of supply, or the lack of good quality properties, houses in particular, that's available for people to buy in comparison to units. But look, that raises an interesting point, John, because we also spoke about this. So the CoreLogic data for last month clearly showed that the Sydney is on the upward trend at the moment. It's turning. I mean, we're talking about maybe less than 1% a month, so it's very, very little, but it is turning. And we will try to explore a little bit in terms of why that was the case, because March, the trend happened before the March rate decision or the April rate decision was made. So April, RBA decided to hold the rates, whereas in March, the CoreLogic data is already started to rebound for Sydney, that is. So it's as if the market has already kind of, I'll say, generally speaking, the market, or people have already foresee that, hey, we are pretty much at the bottom, and disregard whether RBA is going to increase or pause in April, Sydney is starting to turn around and showing a positive figure. Why do you think that was the case? Like, I can certainly tell from finance perspective, we have not relaxed anything. Like the lending standards have not eased at all. Okay, like the APRA still put in the 3% buffer still in place. The interest rates certainly have not dropped, despite the fact that some lenders are starting to reduce a little bit on their variable rates, and we're talking about 10 bips or 0.1%,
Yeah.
very little differences. So but people's borrowing capacity are not increasing last month or this month at the moment, at least no significant changes. So what could have attributed to the rebound of Sydney property market at the moment, do you think?
So I'd actually refer listeners to the YouTube video that you and I did about 4 weeks ago, which has charts and pictures, and it explains all of this, which is where we explain two things. While we do is Sydney real estate expensive, and we do the gold ratio to Sydney real estate. So we, instead of measuring real estate in dollars, we measure it in gold, and then we measure each capital city against each other. And the reason that's important is why Sydney real estate bounced is two reasons. One is it was never as overvalued as people thought back in 2021 anyway. This is one of the key messages that you and I have been saying since 2021. It's like, we're overvalued, but this is not the bubble that everyone thinks it is. It just moved very quickly, but that doesn't mean it's this big bloated bubble like in 2004 after the Sydney Olympics. That was a big bubble that took a decade to wash off. So the first reason is we're never as overvalued as everyone thought. The second reason is that after the correction, sometimes things just get cheap enough, and it became real estate, particularly in Sydney, became cheap compared to everything else. And the way you know that is that during an inflation, when the price of everything is going up, if something is falling while everything else is rising, that asset or that good that is falling becomes very cheap very quickly relative to other goods and services in the economy. And that's what happened last year. So in 2022, when everything else went up by 8 or 9%, and that's what they say that the inflation rate is, real estate went down by 14%. So real estate became 23% cheaper in 1 year. In relative terms, so that's a crash. That is so real estate didn't really just fall 14% last year. The dollar fell by 15%. We had inflation of 8%. So real estate fell by let's say 24% or 30% last year in real terms, and that's a massive correction. So the reason why everyone's jumping into the real estate market now is because it fell very, very quickly and materially quickly. And so don't think about real estate in nominal terms. That's Zimbabwe thinking. Think in terms of real terms. Real estate corrected extremely quickly from a base that wasn't as overvalued as everyone thought it was. Again, look at that gold to real estate ratio in that last video, and it makes it very clear as to why we're bouncing off a bottom now.
No, that's a really good point. So what you're effectively saying is because of the fact that everything else is going up due to inflation, but at the same time, the property values are decreasing. So that accelerated the actual, I guess, when you look at the value of property in that sense, from a relative term, that shortened basically how affordable it is, or now it's starting to look a lot more affordable from the property value perspective, isn't it?
100%. And the way to think about this in a more tangible sense, other than this sort of real nominal, is rents are going up by 10%, real estate's falling by 10%. So suddenly the gap between buying and selling has closed by 20% in a year, in 1 year, or in less than a year, like in 11 months. So that relative price difference, it just closed very quickly. So if we didn't have rents going up and as quickly as they were, and inflation going up as quickly as it went up, and we just had a correction in the property market, then we wouldn't have corrected as quickly. But if you have an inflation at the same time as a property market correction, like rents going up and the same time as property prices coming down, the whole rebalancing just happened very quickly.
I guess maybe also just to give a dollar terms, if I understand is correct, is that, say, for example, milk, a 2 liter milk was $3.80, or I should say 12 months ago it might be $3, and now it's $3.80, whereas a unit in Sydney might be $600,000 8 months, and now it's $550,000. So therefore the money keeps on losing value in that sense, because of the fact that the inflation, everything goes up, but even though everything else is going up, but property prices are coming down. So therefore they go, oh, actually that's a bargain, because $1 10 months ago is not the same dollar as what we see today. essentially.
Exactly.
Right? So
Real estate got
yeah,
left out of the inflation. Yeah.
yeah, exactly.
So
Okay.
it's catching up, and the economy is constantly like it's Benjamin Graham, the mentor of Warren Buffett, described. He said, in the short term, markets are a pokies machine. He said, but in the long term, it's a weighing machine. So so when you make a decision about where you want to live, you're going to decide if it's a rent or buy decision, and you'll be deciding between the relative price of renting versus buying, and eventually there's a tipping point. And no policymaker knows that tipping point, but the market individually knows. So each individual knows their own tipping point, and that's why markets work.
Yeah, I think that's definitely the case because I've got a lot of renters who's very sick about landlords increasing and looking at $100 plus increases in rent. I know it's a bit of a too hard basket because you're going to be paying a high mortgage if you do buy your own home, or you're going to be kicked around by the landlords because of the fact they keep on bumping up the rent. Some of them getting so sick about it, they go, I'm going to buy the bullet and then actually buy our own place, even though the interest rate is high and we know the mortgage repayment is high as well. So that definitely backs up in terms of what you're saying.
I had a client come in 2 weeks ago saying my lease is ending in 6 weeks. I need to be in a property in 6 weeks. So 6 weeks is usually a settlement period. So
That's right.
it means I needed to find, and so
on.
we needed to find it in a week and then negotiate a shorter settlement term. And we did that. So we found a property in a week,
Awesome.
and they were over the moon. But that is an example of, I mentioned before, most of my clients right now are owner occupiers. They didn't want to enter a new 12-month lease at what would have been higher prices. They figured they might as well buy because it's cheap enough.
Yes.
Yeah, so that's that weighing machine in play.
John, I know you also deal with some foreign investors or foreign customers in the past as well. Like, let's say, for example, expats who's got a lot of cash. Do you reckon, I guess, having foreign investors coming back into scooping up maybe the higher end of the property markets? Because I'm hearing, I think it's like definitely during our last few conversations, you're seeing the high end of the city market is rebounding, and it's rebounding fast. I'm assuming it's that because of that foreign market or foreign investors play at that point. So any comments on that?
So right now I don't have any foreign buyers, and
Okay.
I have very recent experience with foreign buyers. As in right now I'm not working with any. So
sure.
But I read what everyone else reads, and I see people at auctions, and I and so on. And what I'm reading is that the Chinese buyers are back in a big way, and Sydney is fast becoming their favorite city. And I know that this is Sydney Morning Herald speaking, so I don't know if it's true. It's like, but I've read this as well. It makes sense. I wrote an article at the beginning of 2022 saying that the dollar's going to the Aussie dollar is going to go below 70 cents, and when that happens, it's going to be a trigger for foreign buyers to come in. It happened maybe a little bit later than I thought it would, but it's definitely happening. And the first sign, the reason the premium side of the market's coming back first, although let's face it, all of the market is coming back at the moment, but the reason the premium market came back first is because I think a lot of foreign money was driving that. So definitely, anecdotally, it's definitely happening, but it kind of makes sense given where the Aussie dollar is as well.
Yeah, so that was leading the market recovery a few months or even weeks back, right? From memory. Yeah. So yeah, and now it's probably the local demand that's now driving the other markets, the rest of the markets as well. So yeah, and to support that as well, I've got some interesting data in regards to the days on market in February and March. So Sydney market, the days on market dropped from 45 days to 39 days. So that's on average 6 days reduction. Melbourne market dropped from 37 days to 34 days, so even lower now. We got the Brisbane market pretty much the same, from 35 to 34 days. So Brisbane market roughly around the same. Perth 27 to 23 days, so definitely a reduction there as well. Like 23 days, you'll be like, that's absolutely red hot there when you look at that, and Hobart 45 to 42 days. So these capital cities, out of like 5 capital cities, are actually seeing a reduction in terms of the days on market, which shows the buyer activities are starting to resurge again, isn't it?
Yeah, I'm surprised to see. See, I view Hobart as the most overvalued capital right now,
Mm.
and I'm surprised to see that it's still got some gas in the tank, and it's the days on market is going down. But yeah, look, it's interesting that we discussed this before we press play, and it's about the trend. So it's definitely showing that most capitals are starting to go up. But what I would also say that look, it's not a feeding frenzy out there at the moment. So I don't want to overstate how hot this
Correct.
market is. It's the market's going up, it's rising, it's kind of finding its base, or it's found its base, and it's definitely going up. But it's not a feeding frenzy. It's not 2021. We're nowhere near that level. But it is a rising market. I'm satisfied to say that. I'd also say, as I said before, units aren't participating in this particular boom. Although I suppose they are in terms of rentals, but uh,
Mm.
so it's not a broad based feeding frenzy by any stretch of the imagination. We're still 10% off where we were a year ago. It's good buying out there.
I do think that's the case as well. Although, yeah, you'll be struggling, and I recently went to some open inspections myself for the Upper North
Mm.
Shore around the Hornsby area. I was primarily looking at the units. I wasn't looking at houses,
Mm.
but I can certainly see, within the markets around the 600 to 800k type of unit range. There isn't that many. Okay, so let me put it this way: the good quality, probably on market value type of properties, you get a lot of foot traffic. So, you'll be seeing something like a 6 to 10 groups, and then the agent will be so busy answering all the questions. Like literally, it's crazy.
Mm.
And then on the other side, where it's probably less attractive, or, stock that's on the market for a while, for a few weeks, you're going to be seeing maybe just a couple groups through, and then, whisper quiet in a sense. So,
Mm.
um, so yeah, it is interesting. I mean, units. This is not a full representation of the whole market, of course, but and it's a very little snapshot. But I do feel, I mean, John, and this is my personal opinion, even though you said units are not participating, I actually feel like they are
Getting there, aren't they?
slowly. I mean, because we're not seeing houses are a complete different beast. We're talking about during auction, they might go 200, 300 above the price guide.
Mm.
Now, there could be a reason because the sales agent lowered the actual price guide a little bit in order to attract more bidders. That's one tactic. Or there's just so much demand for houses, right? So you never know. But for units, I can clearly see this 12 months ago might have only scored 650k. Now the vendors are asking 675 towards 700k as well. So it's creeping up a little bit in terms of the
Mm.
asking price. Now, whether it will get that price or not is a different story, and it depends on the quality of the property, as you said. That's why having a good asset selection here is absolutely paramount. But across the board, I'd say they are edging up as well. I mean, they're
Mm.
not going
Yeah,
up
true.
significantly, but they are edging up as well.
True.
And I suppose that could be because of the demand in general. Just most people can't afford to borrow over 1 mil or that kind of stuff. So, that market is a complete different player. Whereas we're looking at, say, for example, the 600 to 1 mil type of market, that a lot of people are looking, but it's not as active, and they don't have, let's say, maybe not as much bullet in order to be able to
Mm.
fire. So they can edge up a little bit, but it's not going up as crazy as the other markets are.
Yeah.
So
I'm seeing that I bought a unit this week, and for a client, and I'm seeing the traffic as well, but I'm not seeing them pulling the trigger. So I'm seeing a lot of like parents with a kid, like mother
yep.
daughters and mother sons, and those combos, but they don't seem to be making offers quite as. But yes, there's a lot of people that are turning up, so that'll convert. They'll convert to buyers.
Just over time, I guess. Yeah, over time, and they're checking out markets more. So
Interesting.
okay. All right. While we talk on property as well, and rents, that which we touched on, there was actually one important piece of news in regards to rental.
Mm.
Queensland this week has actually updated their rental legislation to reflect only, well, the most critical part is to reflect only one rent increase within 12 months. This funny story, I was just chatting to my Queensland property manager earlier this week as well, and because I was about to renew my lease. And I was thinking, should I just keep it at 6 months? And then because in 6 months' time, I'm sure the rent would have been different again
Mm.
due to the market demand. So should I keep it at 6 months lease? And then I will renew and potentially increase the rent again in 6 months' time. And she responded, if you answer me, if you asked me this question before Wednesday, I would have said yes. But now it's not a Wednesday and it's passed and the legislation is now in place. I would say no. So it just shows how different in terms of having a date stamp there. But yeah, I guess the key message there is, I guess for Queensland landlords, be careful about when you are increasing the rent, because now you can only do it once every 12 months. That will set in place from 1st of July 2023 is my understanding. Okay. But that triggers an interesting question, John, because this is now set in place for Queensland. I wonder what the rest of the state will do. And I think this has been an ongoing debate as well, because people, the renters are complaining, landlords, greedy landlords, you shouldn't be increasing this much. But at the same time, we've got mortgages and interest rates going up a lot higher, a lot faster than the actual rents that's been going up. So as landlords, we're seeing our mortgage repayments are increasing a lot faster than the rents going up too. But at some point in time, or I don't know whether other states are looking at considering that as well, to say there needs to be a cap of some sort to the rent, and whether that's capping the rent increase to once per year or a limit in terms of how much you can increase it by, potentially. What's your view on this, John? What do you reckon?
So I think that this stems from a basic economic illiteracy about what inflation is and why prices go up. So I don't like any interference in prices. I think let prices be determined in the market. And I'll tell you the alternative. I'll tell you the alternative in a moment. But prices get set through a negotiation. And then once they're set, then you can lock them in via a contract. So we're a country with a rule of law. So you can lock them in for 12 months with a contract, and then they don't move after that. But markets need to discover what the prices are. Now, rents don't go up due to greedy landlords. Landlords respond to inflation created by the central bank. So they respond to inflation created by the government's running deficits and monetizing it by the RBA. Now, we have an inflation problem at the moment because we locked down and printed money. And so we have to pay for that through inflation. Now, landlords respond to all that printed money like people who run movie theaters and people who run grocery stores. Everyone's responding to inflation, not creating inflation. There's a famous Milton Friedman clip when he gets asked in this Q&A session, and he said, someone asked him, a student asked him in this Free to Choose series about greedy unions, and he said, do unions create inflation? And he said, no, unions don't create inflation. Landlords don't create inflation. Inflation is created by whoever's creating currency. It's always created by the central bank. So he said, unions don't create it. And in the same way, landlords don't create it. So there's only the RBA to blame and the federal government for creating currency and creating inflation. That's always true. So it's not like true when one side of government's in, not true on the other side. It's always true that inflation comes from your central bank. So what happens if we don't allow landlords to put the rent up? Then you get what the shortages. So the reason why there are famines in socialist countries and not famines in countries that don't have price controls is because if you allow prices to go up, you will produce more of that thing. Prices going up means that there's a signal in the economy that we are running out of that thing where the price just went up.
Correct.
So if we allow rents to go up, that's signaling to the market we're running out of rental accommodation. Quick, produce rental accommodation. And if the price doesn't go up, then there's no economic incentive to have more rental accommodation come onto the market. So you need a signal to make it attractive for rental accommodation come onto the market, and that will push rents down. So the best thing that these governments could do is let rents go up, so that will bring new rental accommodation onto the market and solve the problem by itself. And that's because landlords are only reacting to inflation. So it drives me a bit nuts. This idiocy that we have to tolerate. These people who don't understand anything and they're in charge of the levers of policy. But look, these people have been this stupid since the 1970s when Milton Friedman was asked that question. So anyway, that's a bit of a rant from me. What do you think? I mean, what do you think about rent controls and not allowing rents to go up more than once in a 12-month period? I think if you don't want rent to go up more than once in a 12-month period, have a 12-month lease.
There's a reason why politicians are politicians and they're not economists. I guess let's just put it that way to sum it up. And they want to make sure that the tenants are felt being looked after to a certain degree. So this is obviously Anastasia Palaszczuk in Queensland State Premier is trying to protect what she thinks, and potentially the Queensland government to protect what they think should be doing right for the tenant in this scenario. But like you said, I do agree. I think the main fundamental issue here is not about capping rents or whatsoever. It's about being able to provide more affordable rental properties. When you have more supply, then of course the demand will be met, and therefore the rent would then start to be easing, or the rental pressure would start to ease. That we don't have a solution. I think we touched on this for a number of times. At the moment, there's a rental crisis across the nation. We're not building more. We're not producing more of what people need. So therefore, yes, just by demand and supply theory, that's why rents keep going up. But by capping the rent there to once a year is not a solution. Personally, in my opinion, it's not really a solution at all. It's just a politician decision to be able to make the Queensland tenants felt a bit better, to say, I can, you can, landlords, you can only do one increase every year now. So, but guess what? Landlord's going to factor that in as well. So there might be $150 jump instead of $100 jump across the 6 months. So next time when you see that potentially lease or how much they're being asked for, it's, it might be a harder pillow to swallow as well. So it's to me, it's like a double-edged sword, to be honest. Whether I agree with this or not, I guess is subjective, but we will see how how landlords in general is going to react to this. So
I just also want to touch on this, the vocabulary that we use. I hear it everywhere, and I'm guilty of using it myself, but we talk about a rental crisis. Now, firstly, everything is a crisis in this day and age because we
my bad.
Catastrophize everything. I mean, apparently the world's ending and all that sort of stuff. So I don't buy into this the word crisis, that we completely overuse it. But when rents went down by 20% during COVID, 30% in some instances, I certainly took a haircut on all my rents, which was really tough at the time during COVID. No one called that a rental crisis. And it wasn't a crisis for the landlords whose tenants didn't need to pay the rent. The rents were going down. They were, the banks were calling in loans and all that sort of stuff. So this idea of it's a rental crisis now because it's affecting tenants and it wasn't a rental crisis before when it was affecting landlords is just a difference in perspective. So we that's why I try not to use the word crisis, but it is the parlance at the moment. But if it's a rental crisis now, then I think it was a rental crisis during COVID when landlords took a haircut. So
it never changed. You're absolutely spot on. I think it just depends on what perspectives and what people look at and focusing on at that point in time, that specific time frame. So, that's just keeping our listeners up to date in terms of what's happening. And, even though Queensland's the first one that implemented this, that could mean that could be implemented into other states potentially as well. So just keep in mind and get in touch with your property manager. Make sure you're currently doing your lease reviews as well if you haven't been, because you might be surprisingly to find that the rent will be going up, surprisingly to help you with covering your mortgage repayments. So it is an important thing that the landlords should be carrying out.
There's also David. There's also that anti kind of I don't know what it's called, but where the landlords and their agents aren't allowed to do a bidding process on rents. So you're not allowed to say, we got 620. Are you prepared to go to 640 or something like that? So that's not allowed to happen. The workaround that we're seeing people do there, I think this is what's happening is because you can't negotiate the rent up, landlords asking prices are very high now. So if they negotiate down, they're compliant, but if they negotiate up, they're in breach of the law. So one of the reasons we're seeing a big jump in rental prices is it's a way of getting around this anti-bidding law. So the rents are starting very high, and that's I think a unintended consequence of that law.
Start high and work downward, so we're not in trouble, basically.
Exactly.
Isn't it? So yeah, okay. All right. And I'm glad you touched on inflation and central banks a little bit because I guess this week or the hottest news in the last couple of days is RBA has been reviewed, or the review report has been going on for a couple of months, and the outcome of the report has been delivered to our treasurer, Dr. Jim Chalmers. So they have proposed an interesting change, I have to say, following on US and other, I think, Western cultures or Western central banks. They now want to actually split the operations part of the RBA different to a separate committee just purely determining interest rates. That's my understanding, right? That's the key changes that we're seeing essentially. So right now, and correct me if I'm wrong, John, I'm no economist whatsoever. So just a very layman's term understanding is the RBA board members now controls everything. So they set the interest rate. They obviously review everything.
Yeah.
And they also they determine the interest rate based on a number of factors. And they also set how the operation is going to work moving forward, in that sense. But maybe is an unintended consequence to say, our current governor isn't doing a fantastic job. That's why the recommendation is to say, well, look, that's split out that function in order to be able to have, I don't know, a more specific, economists, having a couple of economists on board that understand how things really work in order to be able to set that monetary policy moving forward. What's your take on that, John? You think it's going to work well for Australia following on from other central banks?
It's being celebrated, but what I think is this idea of having, so broadly speaking, a bit of a breakaway committee of, I think, 8 people meeting 8 times a year rather than 11 times a year, including the ACTU and other economic experts. For the people listening there, I use the air quotes, economic experts. And then they have a press conference. Okay. I think it's hyper centralization of monetary policy. I think it makes monetary policy even more elite. And as I said before, I don't think prices get set behind closed doors. Prices get set in the market. I mean, we shouldn't have an RBA setting interest rates at all. And now we're doubling down on this. The market should set it based on the scarcity and availability of credit. This is how it used to work until the era of central banking, when we have all this volatility in the market. So I don't like it. I don't like that we're doing interest rate adjustments 8 times a year. So in a free market, prices are set every millisecond. Prices are set every time someone buys something and negotiates a price. And now we're moving to 8 times a year for interest rates. Interest rates are the most important price in the economy, and we're doing that 8 times a year. So when something goes wrong, what do we have to wait 3 months until they'll adjust the interest rate? This is not how prices get set. So I think it's terrible. The only thing I do like that the unions are involved in the process. Why not? And the reason I used air quotes for economic experts is, these guys aren't experts. The Soviet Union had economic experts, but they didn't have markets. Markets are the economic experts. All of us are economic experts about our own personal lives. I don't want these policymakers. I don't think they know what they're doing. And they're all kind of Keynesians. They all love their aggregate demand and aggregates. So too much aggregation. I don't like it. One thing I do like is I like that there's a press conference afterwards. I think that's going to be great. They can justify their decisions.
They get grilled, in other words, after their decisions.
yeah. I don't want them to be above the fray. So I'm pleased that there will be they'll need to justify their decision. So I think that's good. What do you think?
And there would be a bit more transparency across as well, right? Because what their decision is going to get published afterwards as well. So right now it's like everyone just sits behind the closed doors, and then, you know, they do whatever they need, and then all of a sudden they pump out to say, yes, it's another 25 basis point. Well, can you explain why? Well, no, that's not part of the mandate, so I don't need to explain. I don't need to justify why. We haven't hit inflation target yet, and here's how we're going to do it, just by keep on increasing interest rates. That's essentially
they come down from Mount Olympus and tell us what the price of credit is this month. It's like, what?
Yeah, so I think it's definitely changing for better from a certain perspective. I mean, I can't really comment on your views on that, because you've got a lot more economic depth from. But if I look at it from a pure layman perspective, to go, okay, well, you know, fair enough. I suppose, like I said, you know, the RBA governor in this case probably haven't done as a good job that you should have done, and this is, the government need to kind of push someone into blame, inverted commas, blaming position. So you go, well, we're going to try to set up a separate board, so that way this area can be done better. Now, whether the outcome of that is really going to be better or not, like you said, I actually don't think the RBA's, to a degree, they don't have full control in terms of how much they can do this, because to a certain degree, we have to follow US's path as well. If US keep increasing, we can't just go, we stop. And, you know, because otherwise the currency is just going to go crazy, right? So to a larger extent, this is probably more of an act to actually help that transparency piece and that communication piece, because moving forward, the governor, whether that's still going to be Philip Lowe or not after September, every time when the decision is being made, he's going to have to front the press conference. He's going to have to be a really good communicator in terms of explaining why the board made that decision. And then afterwards, all that decision is going to be made publicly available for everyone to be able to see which board member voted up, down, or stay the same, or paused, right? So it's proving to be a lot more transparent in that process, which I really like you mentioned. I really like. Now, reducing from 11 to 8 meetings, I don't know. I can't comment on that, because the other central banks are doing it. But I think Dr. Lowe's comments is like, if other central banks are be able to do this, then I'm sure Australia should be able to cope or manage as well moving forward. So that's his personal opinion in that sense. But I guess it's interesting. We will see now. At this stage in time, it's a proposal. It hasn't been. You still need to be endorsed and fully go through Parliament to be able to be legislated, and these improvements then being implemented. But so far, from what we're hearing, is it's mostly endorsed, and it just needs to go through that official process. And it's mostly supported by the RBA's board, including Dr. Philip Lowe as well. We'll see what comes out of it then.
No, you're right, and Dr. Lowe's under enormous pressure for his comments about rates not going up until 2024, and in fairness, I mean, raising interest rates was the right thing to do. So I certainly don't begrudge him. Obviously, the messaging was wrong around that. But one thing that is kind of true of Australian monetary policy is that while there is a reserve currency, we do need to follow the lead of the US Federal Reserve. And if the Fed is lifting rates, we will need to lift rates. And that will be the case until the US dollar isn't the global reserve currency. But while it is, that's what we're going to need to do. And the mistake that Dr. Lowe made was sort of suggesting that Australian monetary policy was completely independent of global currency markets, and that the Fed could go and raise interest rates in the US and we wouldn't need to respond. So that was silly. That was always not going to be correct. But yeah.
Yeah, I think the main thing that stems out of this is that communication piece, which, you came out, like you said, I'm not going to raise rates until 2024. A lot of people bought into that. As a matter of fact, when they look into the data that they published, I think back in late 2021, it's already, the GDP growth is already shooting up very strongly, which means the economy is doing really well. At that point in time, the board members, the RBA board members should have came out, or at least someone should have told or stepped up to told Dr. Lowe to say, hey, tap on shoulder, you should now probably readjust that expectation rather than still keeping the same message to the Australians, because circumstances have changed. We are no longer in a pandemic kind of mode. People are recovering, and they're recovering fast, which means inflations are going up fast. So we will have to raise rates quicker. And if at that point in time, someone has came out not necessarily Dr. Lowe, but it would be great if he'd done it, to say, look, I made that comment last year. However, circumstances have changed, and we now need to start preparing Australians with the increase of rates in the upcoming months. That will set the correct expectation in terms of the communication because of XYZ. I think that will land a better piece for everyone. But having said that, this is probably a positive outcome for Australians, given there's going to be more transparency, better communication from the central banks or RBA moving forward. So why not? Let's see how it goes. Cool. All right. Anything else, John? You want to cover?
No. All good. Just watching this property market grow and stabilize, which is nice.
That's good. Yeah. All right. Well, listeners, thank you guys for joining us again for another episode. We've ranted a lot this episode for some reason, John, but we like to keep it conversational to a degree. So thank you for joining us. And, as always, none of this is financial advice. If you are looking at making a decision, please seek your specific advice for accountants, lawyers, mortgage brokers, buyer's agent, whoever that you work with your team. But until then, we will see you guys again in another fortnight. Cheers, John and David.